And as I just explained in this video, that's how you can grow your account and consistently make money one month after the other. And not just that, you can even beat the S&P 500 and these major indices just like me easily.
Just like me, easily.
Hello everyone. So today I'm going to go over some terms that are important to know when trading stocks. So these are terms related to the stock market, and I believe that they're very important to know. And let's get started. So here, this is just an example. Like this stock that I'm looking at, I'm gonna use it as an example. And this is on Webull. By the way, Webull is a great app. If you want to sign up to it and get free stocks, you can do that using the link in the description below. You'll get like 2 or 4 free stocks, and they can be very good stocks like Apple or Google. They can be worth a lot, so it might be very worth it. So the first thing here, the open, that means when the price opened on the day. So here, like if we use this as an example, you can see that the price here opened at $13.44. You can see that here 20 is for open. So that means that here, that's when the stock price opened at. Like at 9:30, the price of this stock was at $13.44. If you look at the previous close, that means the previous day, the price that the stock closed at on the previous day. So here you can see it's here. The price that the stock closed at on the previous day was around 12 was at $12.36. You can see that the high is the highest price that the stock reached during the day, and the low is the lowest price that the stock reached during the day. You can also see that like here as well and here. These are these 4 terms, and then the next term that is very important is the volume, and the volume means the total number of shares traded on a given period. Usually this period is a day period. Like here, if you look at the volume, it says 1,019 shares traded on that day. So that day was the last day was Friday, the 19th of March. So on that day, a million shares and 190,000 were around a million shares and 190,000 were traded on that day. Meaning that, like, if I am an investor that wants to buy this stock, wants to buy a share in this stock, and another investor wants to sell his share in this stock, then if that transaction happens and this guy transfers his shares, his, like, let's say 1 share to me, then that's a 1 volume on that day. So in other words, I can say that it is the amount of a security that was traded during a given period of time, or you can also say that it's common. The volume is commonly reported as the number of shares that changed hands during a given period of time. Usually, it's the day, as I said. Like here, if you look at this, that's the day volume. So that means that about a million shares were moved from one person to another, or like people from some investors to another on that day. That's the volume, and it's a very important concept to look at. And I believe so. Here you can see that this is the daily volume, and you can see it. You can see it up there too. It says the volume for the last day is 1,190,000, around that. You can also see the monthly volume. If you look at the monthly chart, you can see here that for this month in March, the volume is about 12 million shares traded. That, and again, the volume means the shares that exchanged hands, like they moved from one investor to another. So as I said, if I am an investor and I have a share and I sold it to another investor on that day, then the share was transferred from me to that other investor, and that will count as one, as like 1 volume. So I mean, like, number 1 in the volume. If I had 10 shares that I transferred from me to another investor, then that's a volume of 10 for that day. Hopefully I explained the volume concept or term very well. And then the other concept or term is the average volume. And you can see here the average volume, 3M, means in 3 months, the previous 3 months. And that means that the average volume in the last 3 months is 2 million, around 2 million, 2.63 million shares traded on average. And that means every day, um, the average in every day of these last 3 months is about 2.63. So if I add or sum up the volume for the last 3 months and then divide them by 90 days, then I'll get this number. That's how the average volume is calculated. And then we can go to the other concept or term, which is 52-week high. That means the high, like what is the highest price that this stock reached in the last 52 weeks. So here you can see that the highest is probably at that number 16.86. You can see it here. That's the highest that stock reached in the last 52 weeks. This is a 52 weeks low. So that means the lowest price that this stock has reached in the last 52 weeks is probably 1.86. So it's here in May of 2020. And then we can go to what else is important here. So I would say the shares outstanding. So let's look at the market cap, shares outstanding, and the float. These are very important terms too that I look at. And what that means is that this first term is a market cap or market capitalization. That means that the price of the company. So here it says 140 million, around 140 million, and that means that the price of this company is about 141 million. So if I am an investor or someone that wants to buy this company, like for example, I can say, okay, I want to buy it for its value, and its value is 141 million. That's its value, and that's the price that I can buy it at. So that's the market cap or market capitalization. The next, and it is determined by the price and the number of shares available. So let's get to the next term, which is the shares outstanding. Shares out. It means it's the shares outstanding, and what the shares outstanding means is that this is the total number of shares available or offered by this company. So what does that mean? That means that each company decides on a number of shares that they want to have in the market. So for this company, they said, okay, we're going to issue about 10 million shares. So there are 10 million shares for this company out there, and the market cap is determined by the shares outstanding and the current price. So I can explain it to you in that way. So here in this example, you can see that that means that if we multiply the number of shares outstanding, that's the total number of shares that the company has outside, like available to be traded or sold or bought by people. So these are the total number of shares, about 10 million, 10.03 million. And if I multiply this number by the price, I will end up with a market capitalization, because that's the total price of the company. That's what it is valued at. So if I multiply the total number of shares available by the price, I'll get to that number. And you can see that here. So let's do this example. So if we multiply 10.03 million, okay, by the price, and I don't know how technically you are. I can say that 10.03 0, and then we got another threes. Okay. So that's 10,030,000 shares. Okay. And then I can multiply it by the price now. And what is the number? 141 million point oh two. Okay. And here it rounds it up. The number is rounded up. So here you can see the 140 million. Here is 140 million. 0.02 here, but it's 0.08 here. And that difference is because everything is rounded up. So maybe the shares outstanding are like 10.034, maybe, and they were rounded up. So if I multiply this number by 14.06, I can get the number of 14.08 for, well, I mean 141.08 if I round this number up, which is that number. So that's how it is calculated. And of course, you can also, if you have the market capitalization, and let's say you want to know the price, you can divide this number by that number, by the shares outstanding, or the opposite. If you know that this company is valued at 141 million, like in price, and you divide it by the price, you can get the total number of shares outstanding, which is 10.03 million. So that's the shares outstanding, the market capitalization, and the price. There is also another important term that you got to keep in mind, and that's very important, is the float. And what is the float? So a company has shares, and these shares are called the total shares or shares outstanding. Not all of these shares are available to be traded. So what does that mean for the public? So again, the shares outstanding means the total number of shares that a company has. But not all of these shares are available to everyone to be traded. Some of these shares are held or given to some of the employees or the CEO. Like some of these shares are not available to be traded by everyone like me and you, like investors like me and you. They're not available to be traded. So out of these shares outstanding, there are some shares that are available for the public to be traded, and that's the float. So that means that the number of shares that are available for me and you to be traded are 7 million out of 10 million. So out of 10 million, there are 7 million shares that are available for us, like the public. So these, so, and that's a very important concept, because if you look at like the movement of the price or the stock is very much dependent on the float, because that's the actual shares that are available to be traded. Like, because the other 3 million is probably held by the some people that are not trading it now, so that's like off the table for now at least. So that's why the float is very important. And by the way, the shares outstanding and the float are like the total number of shares, they're not price. The market capitalization is the price, but these are just shares. And as I said, it's still the, like, to know the value of the company, you got to multiply the shares outstanding by the price. That's how we can get the market cap, because that's the total number of shares. It's just some of these shares are not available for the public to be traded, like me and you. And you can see that only 7 million shares are available to be traded by me and you. And here the free float market cap, that's the market cap the float multiplied by the price. But the actual price of the company is the market cap. I hope I did not confuse you too much and I explained it well. But these are very important terms, the volume, the shares outstanding, and the float. And I generally look at the float more, because for me, that's what can cause the movement. Like if the shares outstanding are like Apple, like let's say 1 billion shares outstanding, that means that the stock is hard. Well, okay, let me say that again. So if there are like 2 billion shares outstanding and 2 billion shares float, in the float, that means that the stock is like, it's hard to move. Like it will not move a lot on a given day. Like for these penny stock, they move like 100 or 300-400% in one day. But if the shares outstanding and the float generally is like 2 billion, then you cannot expect this stock to move up like 300 or even 50% in one day. That would be kind of impossible. And in another scenario, if the shares outstanding is like 2 billion, but the free float is like 1 million, then hell yeah, this stock can move up very high in a very short period of time. You can treat it as a penny stock, because that means that not a lot of shares are available to the public at this time. So it means that it can really move high in a very quick period of time. And let me maybe clarify that by giving you an example of like milk bottles. So let's say that a store has like 1,000 milk bottles, okay, and let's consider that as a shares outstanding. And let's say that out of these 1,000 bottles, like the store said that we're gonna give 600 bottles to our employees. So these are not going to be available to the customers for the customers to buy. And let's say there is a shortage or something about the milk that made everyone wants to buy. So there are just 400 bottles of milk that are available for the customers. And that's what can drive like people to go crazy or maybe fight each other because that's the 400 is what's available. So you can say that the 400 bottles are the float versus the 600 bottles, or I mean, like the 1,000 bottles is the shares outstanding. Hopefully, that's a good example and you got the point. So, these are the most important terms, especially when trading a penny stock. But there are also some other terms like the dividend yield, the EBS, the balance sheet. Let me show you Apple maybe. Let's see Apple for more clarification. Did I write it wrong? I don't. It's not Apple. Um, Microsoft. Microsoft. Yeah, there's Microsoft, and it pays a dividend yield. Okay, so that might be a good example. So here for Microsoft, you can see that the dividend yield is about 1%. So what does that mean? So that means that if you look at the price of Microsoft right now, it's $230, and the dividend yield is 1%. So that means that this stock pays a dividend of 1% of its price to the investors that hold their shares. And usually a company pays that dividend once every quarter. So every 3 months they pay that dividend. So that means that the Microsoft pays here it means 1% over the year, but if you want to know the quarter, then that means 0.25% per each quarter. So if we want to estimate that, like right now, you can say 230 around times 0.097. Well, no, 0.097 because it's a 1%. So it's a 20. No, actually, it's not. It's 230 by 0.0097. So you can see that the dividend yield is about $2.2, and you can see here 2.24. That's because I rounded up. I rounded up, but here. So and then we can divide that by 4, and that means that this company, Microsoft, if its price stays at that, then it's gonna pay 55 cents per each share that an investor holds for each quarter. So if I have one share in Microsoft, then I'm gonna get 55 cents like every quarter if the price stays at consistently like that. If I have 10 shares, I'm gonna get this by 10, which is about $5.57 per each quarter. So that's the dividend yield. And as I said, a company pays its dividend yield like it's this 1% is the annual dividend that the company pays, but it pays it every 3 months. So you can divide this by 3 months, which will get you to 55 cents. That's what happens. And I think you can see that here too. Yep. This displays a history of what happened. So you can see that Microsoft paid for the dividend, it paid on the, or declared that it's going to pay dividends to their investors on the 16th of March. And they said that the dividend is going to be 56 cents. 56 cents per each share held by the investor. And you can see that before March, it did that on December, and before December, it did that on September, which means every 3 months they pay this dividend. So hopefully that makes sense. That's the dividend yield. We can go to the other concept, which is the EPS, and that means earnings per share. So the earnings per share is a company's profit divided by the total number of shares that they have, and the total number of shares is the shares outstanding. So the company, of course, like calculates its profit, how much it made in profit, and then it divides it by the total number of shares outstanding, and the price is the earnings per share. So that's what the earnings per share is, and that's how it is calculated. So hopefully it makes sense. And of course, the higher the earnings per share, the better the company is doing. So that's something to keep in mind. You can see that in the financials here, and you can see how their EPS, earnings per share, is growing. So that means that the company is growing, they're making more money or more profits. Sometimes for the penny stocks, or actually a lot of times for the penny stocks, you can see that their EPS is negative, which means that they're losing money, and the total number of money that they're losing is divided by their shares outstanding, and that's what gives the negative number. And here you can see the balance sheet. That's important too. The balance sheet, I don't know if you're familiar with what the balance sheet is or what these terms are, but the balance sheet has three terms, which are the total assets, the total liabilities, and the debt to asset. Or actually, the total asset, the total liabilities, and the total equity. Then this is like a percentage of showing the debt to asset. So, and maybe I'll give you a quick overview about what the balance sheet is or what these terms are. So the total asset is like the assets that you have. I'm going to give you an example to clarify that. And liabilities is the debt that you owe, and the equity is the amount of money that you own, or the percentage that you own in this asset. So let me give you an example by a car. So if you're buying a car and you're financing this car, so of course you're going to pay a fixed amount of money monthly, and out of this money there is a principal and there is an interest. And so let me give you an example. Like, you, let's say you bought a car for $10,000 and you're paying, and like after a year you did your calculations and you saw that you paid about $4,000 in like you paid $4,000 in principal for this car. So that means that your percentage, or the percentage that you own in this car, is 40%, versus the bank owns the other 60%. So in this case, your car is the asset. Your equity is the 40%. So it's the 4,000, which is the 40%. That's your equity. Your total liabilities is the amount of money that you owe to the bank, which is the 60%, or $6,000. So hopefully that clarifies what these terms are. And here the debt to asset means they take the debt, and I believe they divide it by the asset. Um, Probably they do that. They take the debt and divide it by the asset, and and they multiply by 100%. So that gives you the percentage. And the lower the debt to asset percentage, the better the company is doing, because that means that that their debt is very low compared to their asset. So these are pretty much the terms. And so like when I'm looking at a company and a penny stock, I usually look at the float, the volume, the average volume. Um, these are pretty much what I look at. I don't look at the dividend because I'm not going to hold it for a long term. That's my strategy, at least. I don't look at the earnings per share because I know that it's not a very good company. Most likely, I don't care about that. But these are the things that I look at. If I'm looking at a good company, decent company like Microsoft, yes, I'm gonna look at the earnings per share. I would expect it to be positive. I would look at the shares outstanding and I would expect them to be high. The volume should be also high, like in millions, like that. The average volume should also be a high number. I would look at the dividend. If there's the dividend, that's a good thing. That means that I get money for the shares that I'm holding each quarter. So it's a very good thing. And also, by the way, for the dividend yield, it doesn't mean necessarily that if a company is paying a high dividend, then it's a great company. Because think about it, if they're paying a high dividend, that means they're taking a lot of money from their profits and just giving it to the investors instead of investing it in the company and in the company's growth. So for the long term, it's probably gonna hurt the company more, or not gonna be as much beneficial for the company, because they're taking money and just giving it to the investors rather than spending it in the company and growing it, getting new equipment, getting high qualified individuals or employees. So instead of doing that, they're just giving it to investors. So it's not necessarily a good company in terms of growth. So that's just something to keep in mind. And these are pretty much the terms, and I think I went over everything, and I hope that I clarified a lot of things and I made it clear. And if it's not clear, you guys can leave a comment and I'll reply to it and try to make it more clear, maybe make another video if something is not super clear. But you can do that. And if you like the video, I'd appreciate it. If you like it, you can also subscribe to the channel. I'll keep uploading videos about the stocks, what to trade, how to trade, the terms, the review brokers or apps. So I'm pretty sure that this is going to be helpful for you guys. And hopefully you'll be making money like me at one day, and you'll enjoy it. So I wish you the best of the luck. Best of luck.